Hello, I'm Kim Parley. Thank you so much for watching today. The latest issue of Forward Perspectives is out, and this is a paper put out by TD Wealth's Asset Allocation Committee with their view on markets and risk. Now, this committee provides strategic guidance to all of the asset management activities at TD Wealth, and their members have a collective 160 years experience. Joining me here today, Bruce Cooper and Ken Miner. They're both vice chairs of the Wealth Asset Allocation Committee. It is great to have you both here.
Great to be here.
So let's talk a bit about the markets and I guess just trying to understand what's important versus the noise. We have QE has ended in the States. We have geopolitical tensions continuing in Ukraine, continuing in the Middle East. Oil prices are down about 30% since June. Midterm elections in the States. I mean, it goes on and on and on. What are you focused on? Never mind what the headlines are focused on. What are you focused on right now?
So I want to take you back to our key themes, and that is we felt like in 2010 that debt had reached a level in developed and developing markets that we were now going to be in a period of much lower economic activity, and that was going to translate into lower returns. In fact, we saw that as coupon levels on fixed income declined to low single digits. So we came up with this view that fixed income was going to provide coupon-like returns, 0 to 2%, and equities were going to be much more attractive, particularly North American equities, which are going to have mid to high single-digit returns. Mm-hmm. And we have held that view for some time, having this preference for equities over fixed income. So that's foundational to our view. We now look at things and saying you really have to look at things like earnings, what central banks are doing, as you mentioned, and valuations to really figure out where markets are going.
Okay, so given all that, Bruce, then what do you think this environment means for earnings? Because in the last round of earnings we've seen, bottom line actually was looking pretty good for a lot of companies. Top line, okay.
Yeah, and really that's been the story for several years. As Ken pointed out, we've been in this period of slow growth, but actually earnings have been terrific since the bottom of the crisis back in 2009. If you look at the United States, earnings have grown really at a compound annual rate of close to 12% since the crisis, and in Canada it's been 10 or 11%. So that's been an enormous tailwind for equities getting that kind of earnings growth. As we look forward, we think that's going to slow meaningfully from that kind of double-digit level to mid-single digits. Margins today are close to all-time highs. We think there's not that much more room to go there, and so I think earnings are going to more closely track revenue growth, which is going to be in line with nominal GDP growth, which is kind of mid-single digit sort of area.
And what about then, if we talk about the three things you mentioned, earnings and then central banks, we know what's happening in the States. I mean, the QE is over, and people are watching that, but we're seeing an acceleration of that kind of activity in Europe and Japan.
Right. So in middle of 2013, when we were looking at the Fed buying so many assets, we looked forward to a period of time where they'd start to slow their purchases. And we called that a period of deceleration in monetary stimulus. Well, now we've finished that deceleration and we're in a period of pause for the US Fed, where they will take some considerable time to look and see what's happened to their policies and how they're affecting the economy. At the same time, over in Europe, the European Central Bank is starting its own asset purchase program. And down in Asia, particularly Bank of Japan, has doubled up again, expanding aggressively its monetary stimulus, as well as going into an asset purchase program, particularly in equities. So for us, the big tailwind, as Bruce used a minute ago, of monetary stimulus, of acceleration is finished, but they're now going to look at their balance sheet remaining fairly static for a period of time. So it's really only the asset purchase program, the side of it, that they've stopped. Still have a very large and accommodative stance.
So what does all this mean, though, for valuations? I mean, we've had, again, if earnings are going to, it seems, be steady or we're seeing the same level of revenue, again, divergent policies, what does this mean for what we actually hold in our portfolios?
Yeah, once again, I like to go back to provide a bit of historic context. At the bottom of the crisis, stocks were very, very cheap. They traded in the United States, for example, at about 11 times earnings. Today, the market trades at about 16 times earnings, 15 or 16 times. That's the case for both the US and Canada. That's roughly the long-term average, and it's also roughly in line with what we would consider to be reasonable. Equity investors have benefited a lot as multiples have gone up. If you go from 11 times earnings to 16 times earnings, that's almost a 50% return that's embedded in that move over a 5-year period. From here, we expect valuations to be relatively stable and most of the upside to come from that mid-single-digit earnings growth that I described earlier.
What about volatility? Because, I mean, part of the reason it's been such a great run past a while is it's been calmly moving upwards. That's changed.
Yeah, so when we take each of these three aspects of the marketplace and we then look forward, we've been in a period of time where we've had quite exceptional returns, particularly in equities, in a very calm, as you mentioned, low volatile world. Our expectations moving forward is that the returns will be much more muted, but volatility we expect to rise. And so our ask of investors is to just absorb that volatility. We still prefer equities over bonds, but it is going to be more mid-single digit where you're going to have this volatility swings in the market and just look through them with a regular savings program and not panicking just because there's a little volatility in the marketplace.
All right, we will leave it there. Bruce Cooper, Ken Miner, thanks so much.
Thank you.
Pleasure.
Co-chairs of the Wealth Asset Allocation Committee, I'm Kim Parley. Thanks so much for watching.